Every day we use money to buy, sell, and save, but have you ever wondered what money truly is? From its origins to its role in shaping Malaysia's economy, this documentary will uncover how money affects not just businesses and banks, but our daily lives. Money can be defined as anything that is generally well accepted as the medium of exchange, unit of account, store of value, and standard of deferred payment in carrying out transactions in a given economy. Money is mainly in the form of ringgit Malaysia. Moreover, electronic currencies like e-wallets, touch-and-go e-wallet, May, Grab Pay, and internet banking deposit are also considered as part of the modern monetary system.
But before we talk about our topic, what is the characteristic of money?
First, acceptability. Money is used as a main payment method. In Malaysia, ringgit is the legal tender that everyone must accept. Second, durability. Money must be durable. Malaysia's polymer notes are waterproof, so they last longer. Third, portability. Money must be portable. Ringgit is light, and Ditch Now QR enables instant cashless payments. Fourth, scarcity. Money must be limited. In Malaysia, Bank Negara controls it through monetary policy. 5. Uniformity. All money has equal value nationwide. Money has the same value everywhere in Malaysia. Lastly, divisibility. Money can be divided into units for small or large payments, from coins to high-value notes.
After learning about money, many people wonder, what is the function of it?
Money as medium exchange. Before money, people bartered, needing a double coincidence of wants. Money made transactions easier, letting buyers pay directly for goods and services.
Money as store of value. Money lets people save and spend later. People can keep money in bank or invest them. It's convenient, portable, and widely accepted, but its value can drop during inflation. Money as deferred payment. Money is also used for credit or delayed payments. It allows people to buy now and pay later. Money as unit of account. Money measures value, making it easy to compare prices. Such as a computer costs Room 2000, a printer Room 450, a book RM 45.
Let's move on to the difference between commodity money and fiat money. Commodity money is a form of money that has intrinsic value and can be used as a medium of exchange. It is a physical good, such as gold or silver, that has a value independent of its use as currency and can be used for other purposes as well. Beside of gold and silver, salt and accessories also commodity money as long as people can accept the exchange. Fiat money, a currency not backed by a physical commodity like gold, relies on government backing and supply-demand dynamics. In US they used dollar as fiat money, meanwhile in Malaysia we used ringgit Malaysia.
Now that we understand the different types of money, we can move on to discuss the concept of money supply and how it functions in an economy.
Money supply is the total amount of money and liquid assets in a nation's economy on a certain date. The money supply includes all cash in circulation and all bank deposits that the account holder can easily convert to cash. Money supply in Malaysia consists of M1, M2 and M3 based on categories of Bank Negara Malaysia. M1 represents the narrowest definition of money, focusing on funds that can be used immediately for transactions. It includes currency in circulation and demand deposits in commercial and Islamic banks. M1 reflects the most liquid forms of money, cash and deposits that can be accessed instantly. M2 is a broader measure of money supply, including everything in M1 plus savings deposits, fixed or time deposits, and other near money assets that can be easily converted into cash or checking deposits. Although M2 funds are not used directly for payments, they can quickly be transferred for spending, giving a wider picture of the money available in the economy. M3 provides the broadest measure of money supply, including everything in M2 and adding large time deposits, institutional money market funds, and other large liquid assets such as government bonds, commercial papers, and certificates of deposit, CDs. It represents total liquidity in the financial system. After we learn about supply, let's learn how to create money. Commercial banks are the main financial institutions that connect depositors and borrowers. For instance, when banks receive deposits and issue loans, they increase the total money supply in the economy. This process is called money creation. To understand how commercial banks create money, it is important to know some basic accounting concepts. Banks use a T account or balance sheet to show their financial position, what they own and what they owe. The difference between assets and liabilities is called the bank's net worth. Banks are required to keep a certain portion of deposits as required reserves. The remaining amount, known as excess reserves, can be loaned to customers. When banks lend out excess reserves, these loans become new deposits in the banking system, creating additional money. Opening parenthesis. Money creation happens when a customer deposits money in the bank keeps a portion as required reserves, and loans out the remaining funds. Borrowers then spend or redeposit this money, repeating the cycle. Each round of deposits and loans increases the total money supply in the economy. For instance, required reserve by bank is 20% and first customer deposit in bank amount of 100. A must hold 20 as a reserve and the excess will be loaned to second customer. The money multiplier measures how much total money can be created from an initial deposit. It depends on the required reserve ratio. The money multiplier calculate by 1 divided with reserve ratio. A lower reserve ratio allows for more lending and a larger money supply, while a higher reserve ratio reduces the ability of banks to create money.
After we know how a bank create the money, now let's look type of financial institution.
Financial institutions act as intermediaries between savers and borrowers. Savers entrust their funds to these institutions, which are then used for investments, loans, and other economic activities. Borrowers include not only companies but also households that seek financing to purchase private assets. In Malaysia, Bank Negara Malaysia licenses and regulates financial institutions, including commercial banks, investment banks, and Islamic banks. Commercial banks is the most common among the other financial institutions because of its biggest functionality, ranging from making personal daily transactions and so on. In Malaysia, best example given is MyBank, RHB Bank, and Alliance Bank. Investment Bank have been part of the Malaysian banking system since 1970. The main purpose of investment banks is to facilitate overall investment-related activities in the country. One of the famous investments bank in Malaysia is CIMB Investment Bank Berhad, Alliance Investment Bank Berhad and Affin Bank Investment Bank Berhad. Islamic banking plays an important role in economic development as it operates based on Sharia principles, which prohibit interest, excessive uncertainty, and gambling. Instead, Islamic banking emphasizes risk-sharing, fairness, and ethical economic activities. The first Islamic bank established was Bank Islam Berhad, which operation on 1 July 1983.
Lastly, we move into banking system. Actually, how banks are key financial institutions that facilitate the flow of capital between savers and borrowers and are commonly chosen by savers to keep their money. In Malaysia, Bank Negara Malaysia, BNM, established on the 26th of January 1959, is a statutory body responsible for fostering monetary and financial stability. BNM aims to maintain price stability, support sustainable economic growth, and ensure financial system stability through the development of a strong, resilient, and diversified financial sector that supports the real economy.
In conclusion, money plays a crucial role in the economy as it facilitates transactions, serves as a store of value, and acts as a unit of account. The effective use and management of money supports savings, investment, and economic activities. Therefore, proper control and regulation of money by financial institutions and monetary authorities are essential to ensure economic stability and sustainable growth.